it's Carolyn Young here, Chief Executive at Retail NZ, and welcome to today's episode where we'll be discussing the economic outlook for 2025. We expect this episode to take about 10 minutes, so grab a coffee, take a break, and hear from Satish Ranchhod, Senior Economist at Westpac, about the future of the economy in 2025. Welcome, Satish.
Kia ora.
So, great to have you here again today. We've got lots to cover. So, what are the big gnarly questions? Tell us about the trends that we expect to see in the economy in the year ahead.
We're hoping that 2025 is actually going to be a better year for a lot of households and businesses. The last few years have been pretty tough. We were dealing with some pretty powerful headwinds with high inflation, high interest rates. As we've come into 2025, those headwinds are starting to ease off. Inflation's now back around 2%. And importantly, that's meant that interest rates are falling as well. We've seen some pretty sizable drops in the official cash rate. We think there's still a bit more to come. But that is setting up New Zealand for quite a different environment. We're hopefully going to be in a period where households are seeing their purchasing power growing. Over time, we expect that'll support a recovery in spending and business activity more generally. And at the same time, we're also seeing some improving conditions for our commodity exporters, which are, of course, a big part of many of our regional economies. There are some risks, though. We've all seen what's been happening abroad. The changes in US trade policy could have some pretty important implications for us. It's not clear exactly how we'll be affected, but it's certainly an important risk that is a big concern for a lot of businesses right now.
So I understand that, probably somewhere around 50% of households are refixing their mortgage in the next 6 or so months. So in terms of what we're going to see with households and spending, what do you think, what's your sense on what the timing is of when that consumer confidence might move through into a more positive territory and seeing a bit more discretionary spend?
We've already seen consumer confidence picking up over the past few months. I think that's going to continue this year, but I think spending levels really going to start turning higher from the middle part of this year. There's still a lot of householders who have got mortgages and who are yet to roll onto lower fixed rates, but about 50% of the mortgage book is going to reprice over the next 6 months. When they do reset their mortgages, many of them could be looking at a much lower borrowing cost, and that could see a lot of money coming back into their pockets. And if I think about those headwinds we mentioned, well, inflation's eased off, but that just means you're getting less pressure. The reductions in mortgage rates that we're seeing, that'll actually put money back into households' pockets, and it could be quite substantial for a lot of households. And we expect that'll be a big factor that boosts spending appetites, and would also expect it to flow through in a range of discretionary spending areas like apparel, durables, also in the hospitality sector.
And that's good for everyone, right? If we can be spending in those areas, that discretionary spend increases, then the money stays in New Zealand, then it's going to help the growth from a New Zealand perspective. Look, you touched a little bit on the introduction of tariffs from overseas, and I guess if we look a little bit about the strength of the US dollar, can you talk a little bit more to us about what do you think the big concerns are that might come to us later in the year and maybe next year as well?
Tariffs really are the big question mark hanging over the economy right now, and we could be affected in a range of ways. Some of it could be directly if our exporters are impacted by tariffs, and there's a lot of concern about just whether that will happen. President Trump's making a lot of noise today about many economies potentially being subject to those sorts of restrictions. But even if we're not, we could be downstream from a range of other effects if our key trading partners like China are subject to those tariffs. Their demand could slow, and that could ripple through to export demand here in New Zealand. The other thing to keep in mind, though, is that if other economies do slow, say China, well, their exports will still be looking for somewhere to land. That might provide a little bit of a dampener on imported cost pressures, but probably the biggest effects that we will see, and which is less uncertain, is that the New Zealand dollar has dropped, and it's dropped quite considerably over the past few weeks. Now, that is going to be quite an important offset for many of those exporters who will potentially be impacted by tariffs. And it's also giving a boost to spending for our commodity exporters in particular. But it is a little bit of a mixed blessing for the economy. While that's great news for many of our rural regions, for households across the country, many businesses, that lower New Zealand dollar could mean higher input costs. It's likely to push up inflation a little bit. So it's an important buffer, but it doesn't completely shield us from those impacts.
So do you think that would mean that in the provinces they might have a stronger sort of an economic environment around the areas rather than the cities?
Yeah, that's exactly what we're expecting. And it's already coming through in some of the spending figures. If I look at our own data on what we've seen in spending over the last month or so, Wellington, especially looking quite soft, Auckland only seeing some moderate growth. But as we get into our rural heartlands, many of those centres are seeing some strong growth in spending appetites. The lower New Zealand dollar is coming at the same time as we're seeing good growth in prices for some of our key exports, especially dairy. That's giving a big boost to incomes, and we expect it's going to flow through to spending in those regions over the year ahead. So that outperformance of our rural regions is likely to continue through 2025.
So I guess the key message is we've got our fingers crossed that things improve over the next 6 months and that businesses have got a way to manage their cash flow and be agile and adjust to what their customers are looking for, in the hope that we're going to see a better second half to the year with lower interest rates, more spending power in the wallet for consumers.
That's exactly it. Some of those cost pressures are going to be quite immediate. The rates increases, insurance increases, they're ongoing. Reduction in the New Zealand dollar potentially flowing through to higher input costs will also feel that quite quickly. But the pickup in demand, it could take a bit longer. And so that will be a continued strain on many retailers' margins, at least in the near term. But hopefully that second half of 2025 and heading into 2026 will be a brighter period for households and businesses across the country.
Roland, just so everyone's aware, we are recording this before the Reserve Bank Governor's announcement, which is expected next week, where we are anticipating a 50 basis point cut in the OCR. Beyond that, you think further cuts in the next sort of few months?
Well, we think the Reserve Bank's likely to look at some further reductions in the OCR after the February meeting, but we think they're likely to be a bit more moderate. We've already had quite a drop in the OCR, and we think that we're getting close to that period where the Reserve Bank's going to want to ease things off. We're picking another 25 basis points at both the April and May decisions before the Reserve Bank goes on hold. I think while the Reserve Bank wants to stimulate the economy, they want to make sure the labour market remains in good health. They're conscious that we've just had a hard-fought battle to get inflation back at manageable levels, and that's really important that they maintain that. And they'll also be conscious of the fact that while they've been reducing interest rates for some time, the impact hasn't fully been felt yet, and they'll want to see how that flows through and not overstimulate conditions.
Fantastic. Look, we've got everything crossed and hope that businesses can see through those next few months and come out the other side of a really difficult couple of years of trading. Thank you for joining us today, Satish. It's always a pleasure to catch up and have a chat and hear a little bit more about your expertise and knowledge that you've got and how you can help and assist retailers as they move forward.
Lovely talking, Caroline.
Fantastic. And look, thanks to Westpac for your support. It enables us to do everything we can to keep everyone up to date on everything retail. We hope you enjoyed this episode. Thanks for taking a few minutes out of your day to join us. And finally, don't forget to subscribe on your third channel to Retail Unplugged. We'll keep you up to date with all the current industry knowledge. Until next time, ka kite anō. Bye for now. Kia ora.